Hare Krishna. Welcome to Taxguru YouTube channel. This is CA Rohan R. Pingre, practicing chartered accountant based in Mumbai. Also partner in Motilal and Associates LLP, member firm of Marks Network. Welcome to video series What Law Says. And today we are going to discuss case laws reported to ITAT and High Court under direct tax. So today is part 8. So let's dive into it. Let me allow to share my screen. What law says? Direct tax part 8. Today's first case reported to ITAT, Access Securities Limited versus PCIT, IT number 2736, Mumbai Tribunal 2025, relevant assessment year 2020-21, and date of order is 17th June 2025. Let's understand fact and issue of the case. Assessee donated rupees 1.93 crore to Access Foundation approved under Section 80G. Classified as CSR expenses in books, self-disallowed under Section 37, claim deduction under Section 80G in the return of income. Assessing officer allowed the claiming assessment. PCIT, that is Principal Commissioner of Income Tax, revised it under Section 263, holding CSR donations are not voluntary, hence not eligible. What is the point of PCIT to revise the order under Section 263 is CSR donations are not voluntary, hence not eligible. So issue under consideration was, can CSR donations be denied under Section 80G deductions on the ground that they are a statutory obligation? So let's see what tribunal observed and held. Tony was registered under Section 80G. Section 80G doesn't restrict CSR donations. What Section 80G talks about? Section 80G doesn't restrict CSR donations. Section 135 prescribes spending quantum, not mode or doing. What Section 135 prescribes is a spending quantum. It prescribes the spending quantum and not mode or doing. So CBDT circular 2015 CSR is disallowed only under Section 37. Still it is eligible under Chapter 6A, that is including Section 80G. So NCA circular 2016 and past ITAT rulings, for example, Sharda Cocaine support 80G donation, that is 80G deduction. So for Section 263, both erroneous and prejudicial conditions must be made. Here, assessing officer's view was a valid one. So assessing officer's view was a valid one. It is not at all prejudicial or erroneous, okay, which was a precondition to come with a Section 263. So assessee's appeal was allowed. CSR donation to Access Foundation qualifies for deduction under Section 80G, and PCIT's revision under Section 263 was treated as invalid. Very important and good case under for the 80G deduction. So 80G donation means 80G talks about what it is prescribed, what it doesn't restrict CSR donation. That is the important, okay? It doesn't restrict CSR donations. It describes the spending quantum, Section 135, not mode or doing. Very much important. Next, Lakshmanram Bheemaji Purohit versus IT number 196, Bengal, 2025 assessment year 2018-19. Sorry, it's a Bangalore. Date of order 25th June 2025. So relevant sections are Section 44 AD and 69C. Let's understand facts and issue of the case. Assessee, that is individual in the business of trading, West Home Products. Filed return of income on 8th August 2018 under presumptive scheme under section 4480, declaring total income around 5,87,000. Assessing officer received information that assessee had what? Bogus purchase bills amounting to rupees 16,09,000 from Mrs. ARS Enterprise. Alleged false invoices or bogus purchases. Assessee explained that under section 4480, he didn't maintain books or detailed purchase records, but furnished a summary chart of purchases. So, assessing officer rejected whatever explanation and made addition of rupees 16,09,000 in assessment under section 143.3, that exclusionary assessment, read with applicable provisions on account of the alleged bogus purchases. CIT appeals upheld the addition. Appeal went to tribunal. So issue was whether having opted for presumptive taxation under section 44AD, the assessee can be asked to explain individual entries of purchase and whether addition under section 69C on account of alleged bogus purchases is sustainable or not. Very important case, very important and very interesting. Okay, let's see what tribunal observed and held. Under section 4480, the assessee is not required to maintain detailed books of accounts or purchase records as long as turnover is within prescribed limit. What section 44AD talks about and emphasizes is that it is not required to maintain detailed books of accounts or purchase records as long as turnover is within prescribed limit. The AO's reliance purely on GST or third-party data without other corroborative evidence was insufficient. The assessee is not obliged to substantiate every purchase entry unless there is a direct link between that entry and gross receipts. Okay. The bogus purchase addition under section 69C failed because the AO didn't independently investigate or produce credible evidence beyond the third-party data. So tribunal deleted the addition of rupees 16,09,000. Appeal of the assessee was allowed. Next, Cheil India Private Limited versus Deputy Commissioner of Income Tax ITAT number 29, Delhi Tribunal. Relevant assessment year is assessment year 2020-21. Date of order 20th October 2024, and the relevant sections are sections 80G and 37 subsection 1. So let's understand facts and issue of the case. Cheil India Private Limited incurred what CSR expenditure during the relevant year and donated 2 crore 57 lakhs to institutions registered under section 80G. Again, the same issue. In assessment under section 143 subsection 3 in scrutiny assessment section and read with section 144B, assessing officer disallowed the ATG deduction entirely, holding that again CSR spending be mandated by section 135 lakhs voluntarians, which assessing officer considered essential under section 80G. Means voluntariness is required is what is contention of AO. Further, AO invoked explanation 2 to section 37 subsection 1, excluding CSR expenses from wholly and exclusively for business, added the disallowed amount to income, imposed interest, and initiated penalty proceedings under section 270A. So CIT appeals upheld the AO's position that CSR obligation removes the voluntary character of thus no ATG deduction, whether CSR expenditure mandated under Companies Act can be disallowed under section 37 subsection 1, yet still qualify for deduction under section 80G was issued under consideration, and also whether voluntariness is a prerequisite for ATG deduction, and if mandatory CSR undermines that. So let's see what tribunal observed and held. Section 37 subsection 1 and section 80G operate in different statutory spheres. Disallowance under section 37 subsection 1, that is business expense domain, doesn't ipso facto bar the entitlement under section 80G. So explanation 2 to section 37 subsection 1 finance number 2 Act 2014 explicitly exclude CSR expending from business deduction but doesn't legislate away the ATG benefit. Even though CSR is mandated by section 135, donations to eligible donees registered under section ATG are philanthropic in nature and no quid pro quo or reciprocal benefit should exist to donor. In such circumstances, the ATG deduction should stand. So the tribunal placed reliance on coordinate bench decision Ratna Sagar Private Limited versus ACIT Delhi, which took a similar view that the mandatory nature under CSR doesn't extinguish ATG claim. The tribunal allowed the appeal of the SEC. CSR donations, even though mandated to institutions registered under ATG, qualify for deduction under Section ATG, subject to compliance of ATG conditions. The disallowed under Section 37, subsection 1 doesn't preclude the benefit under Section 80G. Kaisha Lifesciences Private Limited versus Deputy Commissioner of Income Tax, ITN number 4311, Mumbai Tribunal. Relevant assessment year is 2020-21. Date of order is 24th of October 2024. And relevant sections are section 68 and section 35 to AB. Let's understand facts and issue of the case. Assessee is a pharma life sciences company engaged in R&D and drug development. In its return of income, the assessee declared what? Nil income. Received unsecured loan of rupees 2 crore 30 lakhs from Mr. Harius Datchanji. Tweeted this as a cash credit and made addition under section 68 for failure to satisfactorily explain its source and credit worthiness. So on the R&D front, the assessee claimed weighted deduction at the rate of 150% under section 35 to AB, amounting to 3.24 crores. But part of this claim related to what expenditure incurred prior to approval date by DSIR, and assessing officer disallowed this pre-approval component around in 28 lakhs plus 5.7 lakhs of capital portions. So issues were whether addition under section 68 is sustainable when identity, genuineness and creditworthiness of a lender are proved, and whether deduction under section 35 to AB is allowable even for R&D expenditure incurred prior to the date of DSIR approval in view of the guidelines and statutory scheme. Very interesting. So let's see what tribunal observed and on section 68, the assessee provided ledger statements, bank statements, loan confirmations, and the lender's return of income. It was undisputed that the opening balance of the loan account as of 1st April 2019 was 3.6 crore, and during the year, repayment of 3.55 crore was made. Thus, the account was a running account. The lender was a 50% shareholder in the assessee company, that is a related party, not a stranger. This fact supported the credibility. What? The share 50% shareholder and the assessee, and therefore it is a related party and not a stranger. On balance, the tribunal held that the identity, genuineness, and creditworthiness were satisfactorily established. Therefore, no addition under section 68 should be made. On section 35 to AB, tribunal observed and held that the guidelines for DSIR approval from 3CM, etc., that is from 3CM, allow that in-house R&D centers recognized by DSIR may be considered from 1st April of the year in which application is made. The tribunal noted that the assessee's R&D center already held valid recognition by DSIR, so the benefit under 35 to AB should be allowed even in respect of expenditure incurred prior to 25th October 2019, that is from the 1st April 2019 as per the guidelines. Thus, the portion disallowed by AO, that is pre-approval expenditure, ought to be restored and allowed. Tribunal allowed the appeal of the assessee. No addition under section 68 and deduction under section 35 to AB is allowed. Next, Bhavesh Bhai Hari Bhai Kanani versus ITA number 254 RGT 2025. Relevant assessment year is 2018-19. Date of order 5th August 2025. And relevant sections are section 44AB and 271B. Let's understand facts and issue of the case. Assessee was in business of trading in brass scrap. Declared turnover of rupees 1.03 crores and profit 7.91 lakhs, that is 7.65% under presumptive schemes under section 44 AD. AO found additional underreported turnover of 11 crore 93 lakhs and treated the case as no account case, estimating income at 4% of total turnover. Return was filed under section 44 AD. Assessee didn't maintain books of accounts or didn't produce them. So, assessing officer initiated penalty proceedings under section 271B for failure to furnish audit report, imposed penalty of rupees 1,50,000, that is CIT appeals confirm the penalty. Whether audit under the issues were whether audit under section 44 AB is mandatory in the scenario when return is filed under 44 AD and no books are maintained. These books are not maintained, so how audit will be there? So whether and after that whether penalty under section 271B is leviable when no books are maintained and no audit report has been furnished. Very interesting case. Please focus and please note down this. Let's see what tribunal observed and held. Under section 44 AD, maintenance of books of account is not mandatory for those availing presumptive vision because no books were maintained and not required under 44 AD regime. Audit requirement under section 44 AB doesn't arise. Penalty under section 271B when it is leviable only when audit obligation exists. Here audit is not required. So how one can levy 271B penalty? So in absence of obligation, penalty cannot be imposed. So penalty provisions are quasi-criminal, mere technical omission or minor breach should not attract penalty. So tribunal relied on President CIT versus Bisoli tractors that held when books are not maintained. Audit under section 44 AB is inapplicable and hence 271B cannot be invoked. The tribunal deleted the penalty under section 271B and also held that audit under section 44 AB was not required in given case because penalty is not leviable. Very interesting. Now next, Sonali Dhawan versus ITO, International Tax ITN number 3748, Mumbai 2025. Relevant assessment year is assessment year 2023-24. Date of order 5th August 2025. Relevant section is section 143, subsection 1 and rule 37BA. Let's understand facts and issue of it. Assessee sold a house property for rupees 2 crore 76 lakh. Buyer deducted 48 lakhs as TDS. This deduction and deposit were recorded in sale deed. In her return of income, assessee claimed TDS credit of 48 lakhs, showing capital gain and credit of TDS. So during processing under section 143 subsection 1, CPC accepted return but denied credit for rupees 47 lakh 99,000. That is almost the entire claim of TDS due to what? Mismatch in Form 26AS. Form 26A showed lesser credit. So very much important. Assessee appealed. CIT appeals directed the AO to grant TDS credit as per Form 26AS. So issue was whether the assessee can claim TDS credit beyond what is reflected in Form 26AS under Rule 37BA, provided she has evidence of actual deduction and deposit. Very interesting. We number of times we receive such kind of notices based on the mismatch in 26AS and whatever return we have filed. So let's see what tribunal observed and held. The tribunal observed that technical system timing issues may result in TDS not being reflected in Form 26AS immediately or fully. So mere mismatch in Form 26A is a not a conclusive bar, especially if the assessee produces reliable evidence, that is bank receipts, taxpayer receipt, etc. of deduction and deposit. Under section 143 subsection 1 clause C, TDS deducted must be taken into account in processing returns. The system CPC shall not rigidly restrict the credit solely based on Form 26S if evidence is available. So the tribunal noted that in case TDS on sale of property, the mechanism is via taxpayer receipt, different from Form 16 and 16A in other cases. Hence, the receipt is relevant to verify the deposit. The AO was directed to verify the taxpayer receipt issued by the Canara Bank in case of assessing dated 17 June 2022 for 48 lakhs as per paper book if found valid to grant full credit. The tribunal allowed the appeal to the assessee, directed the AO to verify the taxpayer receipt, and if it is in order, allow full TDS letter of rupees 48 lakhs claim, and that notwithstanding the mismatch in Form 26A, the credit should not be limited mechanically to the amount shown in Form 26A when valid proof of actual deduction and deposit is furnished. Next, LSI India Research and Development Private Limited versus PCIT ITA number 1061 Anglo 2024. Relevant assessment year is 2017 and 18. Date of order is 23rd July 2025 and relevant section is section 28 clause 4 and 263. Let's understand facts and issue of the case. During the year, the SEC received what fixed assets or equipment valuing 42 crore 89 lakhs free of cost or on loan from its holding or subsidiary companies. The assessee didn't offer these assets as income in its return under section 28 clause 4. The PCIT revisional authority held that the assessing officer's assessment under section 143 subsection 3, that is total assessment read with section 144 144b, was erroneous and prejudicial because no inquiry was made into whether these assets amounted to benefit perquisite income under section 28 clause 4. So PCIT directed the AO to reopen fresh assessments considering these assets under section 28 clause 4. So issue was whether PCIT, that is Principal Commissioner of Income Tax, can invoke revision under section 263 to direct inclusion of free or loan assets as income under section 28 clause 4 when the AO didn't make any inquiry in the original assessment. Very interesting. Let's see what tribunal observed and held. The tribunal observed that in the assessment proceedings, the AO didn't make any inquiry or seek evidence regarding whether the assets were provided on returnable basis or were for the assessees used and benefit. The PCIT order under section 263 was based on assumption. Actually, it should be on if it is AO's order is prejudicial or erroneous to the interest of the revenue, then only 263 can be invoked. It should not be based on the assumption. So not on record that the assets will amount to income without AO's own evaluation of findings. The tribunal held that revision power cannot be used to direct the AO to make fresh additions on issues not touched in the original assessment unless the original order is proved erroneous. That is, main conditions erroneous and prejudicial to the interest of the revenue. So it relied on established jurisprudence that if assessment order didn't deal with particular issue, the revisional authority cannot proceed to treat it as an error and direct fresh scrutiny on that issue. The tribunal set aside the PCIT's revision order under section 263. The tribunal directed that in reassessment proceedings, if validly initiated, the assessee may explain and prove that the assets were received on returnable basis and the AO must decide on that basis. In short, PCIT's invocation of revision to treat those assets directly as income under section 28 clause 4 without AO's inquiry was unsustainable. Now we are moving to cases reported to High Court. Let's understand first case. Skyscraper Projects Private Limited versus Additional CIT Appeals, CIT 2011 assessment year is 2012-13. Calcutta High Court, date of order 28th July 2025, and relevant section is section 43B. Stay tuned till the end of the video, because at the end of the video we will discuss one-liner conclusions that can be drawn from the cases discussed today. So be there till the end. So issue was section 43B of the Income Tax Act. The case revolves around the question of whether payments made by the SEC for certain expenses such as statutory dues are deductible when such payments are made after the end of the accounting year, but before due date for filing the return of income. Very interesting issue. Issue was whether payments made by the SEC for certain expenses such as statutory dues are deductible when such payments are made after end of the accounting year, but before the due date for filing the return of income. Let's see what Calcutta High Court observed and held. Section 43B of the Income Tax Act allows deductions only when payments for certain expenses such as provident fund, bonus, tax are actually made in the relevant financial year or within the specified time. The court emphasized that even though the expenses might be occurred in the previous financial year, unless paid before the due date of filing the return, the deduction will not be allowed under Section 43B. The court noted that statutory dues like service tax, VAT need to be paid within the prescribed time limits to avail the benefit of deduction. The assessor's contention that the payments were made before the due date of filing the return of income was considered but found to be lacking sufficient proof for the deductions. The court referred to earlier decisions that had held that deductions under 43B can only be claimed if the payment is made by the due date for filing the return of income. The Calcutta High Court held that the payment was not made in accordance with Section 43B, and therefore the claim for deductions of statutory dues could not be allowed. The ruling reaffirmed that payments must be made within the prescribed timeliness for the relevant deductions to be admissible, regardless of the fact that the expenses were booked in the previous year. So, should be made within the financial year or from up to the date of filing the return of income. So next, Anurag Dalmia versus ITU, relevant assessment years 2006, 7 and 7, 8. Delhi High Court, date of order 21st July 2025, and relevant sections are 276C, read with section 5, 271, 276D, and 277. Let's see what was the issue. The case pertains to section 276C, 271, 276D, and 277 of the Income Tax Act, focusing on what willful attempt to evade tax. The main issue is whether the assessee was guilty of willful attempt to evade tax under these provisions, leading to penalty and prosecutions for concealment of income and false statements. Let's see what Delhi High Court observed and held. The court observed that for a person to be prosecuted under Section 276C for willful tax evasion, there needs to be what? Deliberate attempt to evade tax by concealing income or furnishing inaccurate particulars. Mere non-payment of tax or incorrect reporting doesn't automatically lead to criminal prosecution unless there is a evidence of willfulness. That is more important. So the court discussed how penalties under Section 271 for concealment of income are not automatic but depend upon clear finding of mens rea, that is guilty mind, and the nature of the violation. These sections address prosecution for false statements made in income tax returns or documents. The court emphasized that these provisions are stringent and should not only be applied if there is clear intention, and should only be applied if there is a clear intentional fraud. So the High Court stressed that the mere discrepancy in reported income or underreporting doesn't by itself prove criminal intent. evidence of willful attempt to evade tax or deliberate falsification of records is necessary for invoking these sections or provisions, these serious provisions. The Delhi High Court ruled that the prosecution under these sections was not justified in this given case, as there was insufficient evidence of willful concealment or false statements made by the assessee. The court quashed the charges of prosecutions, noting that the mere failure to disclose correct income or inaccuracies in the return without clear evidence of international fraud or willful evasion is not sufficient to attract what criminal prosecution. The court highlighted the penalties under Section 271 for concealment of income will depend on the facts of the case, and without proof of willful concealment, penalties should not be imposed lightly. Next, Principal CIT versus IBM Australia Limited, relevant assessment year is 2018-19, Karnataka High Court, and date of order is 31st July 2025. Relevant sections are Section 9, subsection 1, clause 7, and 270A. Let's see what was the issue of the case. The case involves Section 9, subsection 1, clause 7, and 270A of the Income Tax Act related to what? Taxability of fees for technical services and penalty for under-reporting income. So issue was whether the payments received by IBM Australia for services provided to an Indian entity qualified as fees for technical services under the relevant section, and if the assessee was liable for penalty under Section 270A for under-reporting income or not. So let's see what Karnataka High Court observed and held. Court discussed whether the payments received by IBM Australia for its services to an Indian entity fall under the definition of fees for technical services. Okay. High Court observed that technical services, as per the provisions, refers to what? Services requiring specialized knowledge or skill. IBM Australia services were found to be within the ambit of that particular definition. The court noted that the permanent establishment of the foreign company in India was not relevant to determine the taxability of these payments under Section 9, subsection 1, clause 7, as the services were rendered in India. The court addressed the penalty provisions under Section 270A for underreporting income. Section 270A imposes a penalty when the taxpayer deliberately underreports the income. So the court considered the assessee's arguments regarding reasonable cause and whether the underreporting of income was willful or based on bona fide belief regarding the nature of services provided. The High Court further emphasized the need for contextual understanding of what qualifies as technical services, and that services provided by a foreign entity to an Indian entity will still be classified as technical services if they meet the statutory requirements. The court upheld the assessment of the payments as fees for technical services under Section 9, subsection 1, clause 7, thereby making the payments taxable in India. So the court ruled that the penalty under Section 270A for underreporting income will not apply in this case. It was held that the assessee had a reasonable cause for underreporting stemming from a bona fide belief that the payments didn't qualify as a FTS. The penalty was not warranted as the underreporting was not deliberate or due to willful misconduct. Means it must be deliberate and willful misconduct should be there to warrant the penalty under Section 270A. Center for Policy Research versus CIT, relevant assessment year 2022-23, Delhi High Court, and date of order is 9th May 2024. Relevant sections are Section 156 and Section 220, subsection 6. Let's see what was the issue. The case concerns Section 156 and 220, subsection 6 of the Income Tax Act, specifically dealing with demand notices and stay of demand during the pendency of an appeal. Main issue was whether the CPR was entitled to stay of demand under Section 220, subsection 6 on the tax liability determined by determining the assessment for assessment year 22-23, despite the demand notice issued under Section 156. Let's see what Delhi High Court observed and held. The court observed that Section 156 authorizes the AO to issue a demand notice if any amount is due under the assessment. In this case, demand notice was issued for tax dues. The CPR contested that demand, stating that it was a charitable organization and thus eligible for what exemption under section 11 of that, which was not considered during the assessment. The code highlighted that section 220 subsection 6 allows the taxpayer to seek a stay of demand if the appeal against the assessment is pending before the appellate authority. The code what highlighted that the taxpayer to seek a stay of demand if the appeal against the assessment is pending before the appellate authority. The CPR had filed an appeal challenging the demand and it sought a stay on the recovery of the amount until the appeal was decided. So the court noted that stay of demand should not be automatically denied and the taxpayer is entitled to such stay provided there is a prima facie case for the appeal and the taxpayer is willing to provide an adequate security. The court considered the nature of the organization and its entitlement to the exemption under Section 11 of the Act, which was a central issue in the appeal. The court recognized that the prima facie merits of the case were in favor of the taxpayer. So the Delhi High Court held that CPR was entitled to stay of the demand under section 220 subsection 6 as there was a prima facie case in favor of the taxpayer. Court directed that the demand be stayed conditionally subject to the CPR providing an adequate security for the demand. Recovery of the tax demand was not to be enforced until the appeal was adjudicated subject to the conditions imposed by the court. Next, Crown Electromechanical Private Limited versus Principal CIT. Relevant assessment year is 2022-23 and High Court is Calcutta High Court. Date of order is 15th July 2025. Relevant section is section 264. So issues where Principal CIT had the power to revise an order passed by the assessing officer under section 264 and whether such revision was valid when the assessee had already filed an appeal against the order. Very important case law. Please note down what was the issue. Issue was whether Principal CIT had the power to revise an order passed by the AO under section 264 and whether such a revision was valid when the assessee had already filed appeal against the order. So let's see what Calcutta High Court observed and held. The court reviewed the provisions of section 264, which empower the principal CIT to revise any order passed by the AO if it is found to be erroneous or prejudicial. If it is to be found to be erroneous or prejudicial to the interest of the revenue, then only principal CIT can revise the order under section 264. The court noted that section 264 allows the principal CIT to intervene even if an appeal is pending, provided the revision is necessary to correct any errors or to protect the interest of the revenue. The High Court observed that in this given case, the AO had passed an order which was contested by Crown Electromechanical Private Limited, arguing that it contained errors or was prejudicial to their interest. So the principal CIT had initiated the revision proceedings, asserting that the order of the AO was erroneous and required rectification. Court discussed the legal position that an appeal before the appellate authority doesn't bar the principal CIT from exercising his revisionary powers under section 264. The court emphasized that section 264 allows the principal CIT to revise any order even if an appeal is pending, as long as the revision is aimed at correcting the errors that affect the taxpayer rights or the interest of the revenue. The High Court clarified that the revisionary power under section 264 is discretionary and can be exercised only if the principal CIT is satisfied that the order is erroneous or critical to the revenue. So the Delhi High Court upheld the principal CIT's decision to revise the order passed by the AO under section 264. Court ruled that the principal CIT had the legal authority to revise the order even though an appeal was pending, as the revision was based on the erroneous nature of the order passed by the AO. The court directed the principal CIT to dispose of the revision in a manner that protects the interest of the both taxpayer and the revenue, ensuring that the corrective measures are taken as deemed appropriate under section 264. And that's it But today and now we are moving as a promised. At the end of the session, we are discussing one-liner conclusions that can be drawn from today's case laws discussion. So let's see. First conclusion, taxpayer must provide clear evidence of their claims for deductions, and the PCIT has the authority to revise the assessments if the claims lack sufficient substantiation. You can take a screenshot for your ready reference. The ITA allows the ITAT to consider evidentiary submissions at any stage, but failure to do so timely may result in adverse inferences drawn by the authorities. Taxpayers must demonstrate that their expenses incurred are wholly and exclusively for business purposes to claim deductions under relevant provisions of the IT Act. The DCIT's discretion to reject claims for tax credits or deductions is upheld if the taxpayer fails to meet procedural requirements or lacks adequate documentation. Taxpayer must comply with notice requirements under Income Tax Act, and failure to respond or comply can result in what? A rejection of claims or penalties. So it is very important, once you received a notice from the department, you must respond it. International tax cases require a true understanding of the double tax avoidance agreements provisions to avoid the double taxation and ensure correct application of tax rates. R&D expenditure must be substantiated with a proper documentation and justification for claims under Section 35(2)(ab) of the Income Tax Act. Deductions under Section 43(b) are only allowed if the statutory dues are paid before the due date for filing the return of income. Prosecutions under Section 276C, 276D, and 277 requires what? Proof of willful tax evasion or fraud, and mere underreporting without a fraudulent intent doesn't attract criminal penalties. Mere underreporting without any fraudulent intent doesn't attract criminal penalties. Foreign entities' payments for services rendered in India are taxable as fees for technical services under Section 9 subsection 1 clause 7, and penalty under Section 271 can be avoided if there is a reasonable cause for underreporting of income. A stay of demand under Section 220 subsection 6 can be granted even if an appeal is pending, provided the taxpayer offers what? Reasonable security and shows a prima facie case. The principal CIT has the authority to revise an order under Section 264 even if an appeal is pending, provided the revision is based on what? Correcting errors that affect the taxpayer's right or the interest of the revenue. What? A principal CIT has the authority to revise an order under Section 264 even if an appeal is pending, provided the revision is based on what? Correcting errors that affect the taxpayer's rights or the interest of the revenue. And that's it for today. Please note down my contact numbers. If you have any questions, observations, suggestions, do let me know through email or on WhatsApp. Be connected there. Also connect to the Taxguru YouTube channel. If you are not yet subscribed, then do subscribe it. And if you like this video, then please click on like and do share in your network. So that's it for today. We will meet soon in next video. Thank you. Thank you so much for patient hearing. Bye bye. Take care. Hare Krishna.